So hello everyone. Thank you for joining us today. My name is Chloe. I'm a research analyst from IFAS. Today, I'll be sharing more about our ETF Focus List, which contains some of the best-in-class ETFs and serves as a starting point for your investment journey. So here's the outline of the presentation today. I'll start off by giving just a brief introduction to ETFs, followed by moving on to share about how we choose our ETFs. Last but not least, I'll be sharing some snippets of our 2022 edition of our ETF Focus List. And this could actually help to guide you through your investment journey. So without much further ado, let's begin with a brief introduction to what exactly are ETFs. So an ETF is actually an exchange-traded fund, and they represent a basket of securities that allow us to reach every corner of the market. So an ETF can contain that of a portfolio of stocks, bonds, as well as other asset classes. And most of the ETFs out there, they're passively managed, and they aim to produce a return that replicates an underlying index. So the underlying index, in a sense, could be a market index like the STI, as well as the S&P 500, or an index that is for a specific sector like the Hang Seng Tech Index, which tracks a basket of Chinese tech stocks. As mentioned just now, there are many different types of ETF, and the range is so wide that it allows us to reach every corner of the market. So the most common type of ETFs will be that of equity ETFs, and they track this equity market of a specific industry. There are also a lot of fixed income ETFs out there, and they can track a corporate bond market or a government bond market. So other than these two types, ETFs can also provide us an exposure to alternative assets, and this can actually serve as a hedge for one's portfolio, such as commodities as well as currencies, for instance. So given that there are so many ETFs out there, choosing the right ETF could be actually a pretty daunting task. And given that not all the ETFs are made equal, I would like to share a few factors to consider when selecting an ETF. And this is also the methodology that we will use for our ETF focus list. So when choosing an ETF, we consider things such as the quantitative as well as the qualitative factors. So under the quantitative factors, we consider things like the expense ratio, liquidity, as well as tracking difference. So first, when we look at the expense ratio, and this is actually the annual cost that investors have to pay in order to cover the ETF's operating expenses as well as management fees. So we tend to prefer ETFs that have a lower expense ratio, as all things equal. Assuming that an ETF has a lower expense ratio, it also means it lowers your net cost, and this would translate into higher net returns. The second factor we consider is that of liquidity, and this refers to how easy it is to buy and sell an ETF without affecting its price. So we prefer ETFs that are more liquid. So this means that it will have a higher daily average volume as well as a smaller bid-ask spread. So lastly, for these quantitative factors, the third factor we consider is tracking difference. And this is the difference between the ETF's performance and the performance of the underlying index, as most of these ETFs out there, they actually track an underlying index. So all ETFs will have this tracking difference, and this usually is due to factors like expense ratio, rebalancing costs, as well as currency hedging costs, so on and so forth. So having a smaller tracking difference is more desirable, and it means that the ETF is closer to the performance of the underlying index in the sense that you're trying to track. So after considering these quantitative factors, some other qualitative factors we choose to look at when going about our ETF selection methodology is that of the choice of index. So this is pretty important as the underlying index has to be a good representation of the market and the sector that the ETF is intended to track. For example, if you want to, let's say, access Chinese tech stocks, the Hang Seng Tech Index in this case would be more relevant than, let's say, the Hang Seng Index. So one way to gauge the underlying exposure is to actually look at the investment objectives as well as the top 10 holdings, which can all be found in the ETF fact sheet. Next, for the other qualitative factor we look at, we consider the structure of an ETF. So ETFs can come in either a physical or synthetic structure. The majority of ETFs out there are physical, and what this means is that they actually hold the underlying securities that make up the index that they are tracking. However, there are a couple of synthetic ETFs out there, and they rely on derivatives such as swaps to execute their investment strategy. So it allows investors to actually gain exposure to illiquid markets as well as hard to access markets such as commodities. But synthetic ETFs, they use derivatives, and so investors are often exposed to the counterparty risk. So we generally prefer physical ETFs, as in this case, they tend to have less and limited counterparty risk. So this sums up the various factors we consider in our ETF selection methodology. And with this, I've actually hoped to have given perhaps a little idea on how we go about selecting ETFs for our focus list. And so with this, we also reached the highlight of my presentation today. And this includes sharing snippets of the latest edition of our ETF focus list. So to help guide investors through their whole investment journey, we first introduced this ETF focus list in 2018 and we sift through thousands of the ETFs out there to identify the best-in-class ETFs for our ETF focus list. So to ensure that our recommendations, they also remain current as well as relevant, this ETF focus list is updated on an annual basis. So we have made a couple of changes to this list this year in order to reflect the wider range of the ETFs which the world has to offer. So firstly, we made changes to our China A-share recommendation under the core equity category. So China A-share here, it refers to those stocks that are listed on the Shanghai as well as the Shenzhen Stock Exchange. So there are two common indices that are typically used in order to track this exposure, and this is the CSI 300 index as well as the FTSE China A50 index. So this CSI 300 index, essentially what they track is that they track the largest companies trading on the Shanghai and Shenzhen Stock Exchange, and they are considered the blue chip index for mainland China Stock Exchange. While this FTSE China A50 index, on the other hand, they actually track about 50 of the largest companies that are trading on the Shanghai and Shenzhen Stock Exchange. So seeing that this CSI 300 index is the more commonly used mainland China benchmark and comprises a wider universe of A-share companies as opposed to that of the China A50 index, we actually decided to change our recommendation from the iShares FTSE China A50 ETF to that of the iShares Core CSI 300 ETF this year. And also in light of whatever is happening in terms of the geopolitical tensions and Russia's invasion of Ukraine, many countries out there, they have imposed sanctions on Russia. And due to a lot of this severity of sanctions, as well as ethical issues that are now facing Russian companies, we believe that most fund managers will not be able to wait out this situation and will be forced to pivot away from Russia or forced to close entirely if they fail to do so. And more importantly, we are aware that these armed conflicts are a violation of human rights and they cause substantial humanitarian suffering. So as a research house, we do have a responsibility to uphold our investment values as well as ethics in light of all these human rights violations. So in addition to removing Russia from our ETF focus list, we've also disabled Russian products and ceased coverage on Russia. And next, we've also added China property bonds into the fixed income category. So as we all know, this Chinese property sector, they saw turbulent times in 2021. And following the dramatic sell-off last year, we believe that investors have actually priced in a large degree of credit stress. And the spreads of China property bonds, they've also reached one of their highest levels on record. And so with the worst of likely behind in terms of China property sector, we think that this year could actually be a better year for the sector as a whole. And supportive policy fine-tuning has actually been rolled out in China to prevent a systematic crisis and also to stabilize the housing market. So we see that these bonds, they offer a combination of high yields as well as shorter duration. And with this, we actually recommend the Premier China USD Property Bond ETF for such exposure. And besides some of the key changes mentioned above, we've also made notable changes to the tactical plays category. Firstly, we removed China financials from this tactical plays category. Our previous recommended ETF for this China financials was the Global X MSCI China Financials ETF, also known as CHICS in short. And this ETF has many similarities with our ETF for China banks. And this is the China AMC Hong Kong Banks ETF, also known as 3143. But given that the previous recommended ETF for China financials is CHICS, and CHICS is US listed, so what this means is that it's subjected to a 30% dividend withholding tax. And after considering the dividend withholding tax, this average forward dividend yield for CHICS is about 5.25%, and this is compared to that of a 7.29% for this China AMC Hong Kong Banks ETF, also known as 3143. So this makes CHICS less attractive for income-seeking investors, and hence we have removed China financials from our ETF focus list. And you can see the overlaps within the next slide. So as seen in the table here, okay. As seen in the table here, you can see that there are many overlaps. Sorry. You see in the table here that the ETFs, they actually share many similar holdings as highlighted in bold. So for instance, things such as China Construction Bank, as well as the Bank of China and China Merchant Bank, these are the common holdings within the ETFs. And besides these removals, we've also made about 6 new additions to our tactical plays category. And we included things such as China electric vehicles as well as China clean energy as new additions, as we see the rapid expansion and growth of these two sectors, especially going forward. And do note that the Chinese government is also supportive towards the development of both these industries due to their alignment with their long-term green goals, as China ultimately has this goal of achieving peak carbon emissions by 2030, as well as carbon neutrality by 2060. So we think that these two sectors could benefit from such long-term plans. So cybersecurity is another new addition to this tactical plays category, as increasingly the world is undergoing this massive digital transformation, and cybersecurity has become more important than ever. So cyber attacks have increased in greater numbers, and there's a need to actually impose new and tighter cybersecurity laws on organizations to protect as well as to secure their data. So we think that moving forward, those investors who are keen on this sector can actually consider the Global X Cybersecurity ETF. And this is designed to actually track the performance of the companies that are primarily involved in cybersecurity. So besides cybersecurity, as seen here, we've also added robotics as well as AI to our tactical plays category. Increasingly, we find a case where robots are increasingly now more commonplace in both the manufacturing floor and our daily lives. So artificial intelligence has also allowed these robots to become increasingly efficient. So given this trend towards the greater automation, robotics and AI, they are the industries of the future, and investors can gain exposure to this sector via the Global X Robotics and AI ETF. And these are the last two additions that we have made to our tactical plays category. And as seen here, they are that of the agribusiness as well as the metal sector. So we decided to include agribusiness and been covering this space since August last year, due to the fact that increasingly we find the issue of food security has become increasingly brought to the forefront, especially now with the rising food price and with the current Russia-Ukraine war. So this food business is a critical industry and one that is growing in importance as well as opportunity for investors, as the broader secular trends such as population growth as well as income growth, they've also underpinned the industry's long-term potential. So investors who are looking to tap into this mega trend should consider the VanEck Agribusiness ETF, also known as SMOE. For metals, we see the case where the world is moving towards this clean energy transition, and these rare earth and strategic metals, they've made this possible. So they are important in developing both these emerging as well as new green technologies. And so investors who are interested in this space may consider the VanEck Rare Earth Strategic Metals ETF. So to view this full list of ETFs, please visit our FSMOne homepage, then go to the ETFs or the Research tab, and you click on the ETF Focus List. And you will then arrive in this page. And then you can switch between the 6 different categories that we offer as shown here to actually discover our ETF Focus List. So all in all, our ETF Focus List, they serve as a good starting point for investors who are seeking diversified exposure to markets at a low cost as they zero in the best-in-class ETFs. So you may notice that some of the ETFs from last year, they did not make this year's ETF Focus List. But if you're holding on to them, please do not worry, as they are still viable investment options for your portfolio, and they will continue to remain available under our ETF regular saving or RSP plan. So with this, I'd like to thank everyone for coming here today, and I'll come to the end of my presentation. So thank you very much.